Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. In late May, the recent market peaked at the January 2022 low at 739. Turning lower and not really stopping until the dark blue highlighted neckline of the February to April reverse head and shoulders pattern, currently at 571. Since then we've seen a slowing down and most recently a resurgence higher. Congestion from mid-February to late April impacted on the market's decline, and we formed a small bear channel since late June to the end of August, highlighted in bright red on my daily chart. That's currently 518 to 561. I believe that one should not look at this bear channel in isolation. Instead, look at it as part of the V-top becoming a V-top. So we've got V-top with an extension formed since late June. So what can we tell from such a pattern? Well, usually such V-top patterns with extensions are small, much like the size of an earlier small descending triangle during early middle June, and usually pennants or bear flags. Not so in this case, but it does not take away from the idea to have such a larger pattern attached to the V-top. Thus recently I've been highlighting how the market would look for the bear channel lines to show some of the immediate support and resistance, which we'd have seen throughout July and August. The pressure in such a pattern will tend to be for lower prices, but last week the market struck the important 38.2% absolute Fibonacci line below at 529, which ignited a very recent bullish incentive, enough to push up and out of the bear channel, as well as over the green short medium moving average, currently at 561, the December 2020 low at 566, and a dark blue neckline of the small February to April reverse head and shoulders pattern, up into a fairly free area. However, the market's having a hard time exploiting this, as we are still within the previously mentioned mid-February to late April congestion, as well as the newer July to date base congestion that stretches up to the March 2021 low of 592. That is not all. A little above we have the flatlining gold long moving average, currently at 596, and the flatlining mauve medium moving average, currently at 600. All this is weighing in on the market, plus the certain natural tendency for V-tops with extensions to be somewhat bearish. Thus would still keep a wary eye on the downside, even as we have moved higher, as I have suspicion right now that this might be a false move higher. If it isn't, great. But we need to be at least seeing consecutive closes over the 50% Fibonacci line, the May to August move at 630 to consider such a situation as a longer term possibility. All that being said, enough has happened for me to place a target X at 604 as a potential target for this move up and out of the bear channel. I'm quite prepared to retire this target next time. Chicago corn. From the small double top pattern in May, prices headed lower, below all the moving averages in mid-June, accelerating the fall once past the hurdle of the November 2020 high of 439. Prices finally halted between the November 2020 low at 403 and the October 2020 low at 387, creating a teeny triple bottom and recovering all the way up to the high 6 weeks ago with a 50% absolute Fibonacci line of 425. In the process of pulling back up, the market made a small July-based ascending wedge pattern. Late 6 weeks ago, prices penetrated the lower trend line and exited the pattern. The market easily reached the primary target, but it took until mid-August to drop down and reach the secondary harder to reach target. 3 weeks ago, I added a thought, and that was to look at the mid-June to late August action as a possible descending triangle. There were arguments against this idea, but I did find it elegant at the time. 2 weeks ago, prices exited out of the upper trend line of this descending triangle idea, highlighted in dark blue on my daily chart. But instead of heading higher, they headed lower, down towards the flat lower trend line, currently at 390. This then looked like a false break higher, but what the market meant to do was head lower. And prices did turn lower, but before I could get to that, the market created another pattern. A late July to late August, shallower, smaller descending triangle. The upper trend line is highlighted in red on my daily chart. This triangle, like the former one, could also have a false break until the market settles down on its true journey. So since last week, I've seen prices head higher, punching this week through the purple late May to date downtrend, currently at 401, and its accompanying green short medium moving average, currently 405. This break high has reached the primary target for the bright red descending triangle, but I've chosen this week not to lay out the secondary, at least not for now, which is close by in the 418 area, as I have a concern still about this market. My concern is that this rally, despite we have seen since the low of last week, may not have the legs on it. I say this after highlighting that last week was a weekly key reversal up as well, so you can see it's a hard thing for me to discuss. Yet despite all this, right now I have my doubts about this rally. We have immediately overhead the February low at 409, then the December 2020 low at 414, with next the significant and important 50% absolute Fibonacci line beyond that at 425. Kansas City wheat. During February through to April, we saw the development of a rectangle pattern based on the 551 to 590 area. Now, please remember this area, especially the lower level, the 551 area, as we become relevant again to the more recent action. Anyway, after the creation of the V-top in late May, prices rapidly descended down to the extension to the lower dark blue lower trend line, currently at 580, of the late November 2023 to end of March 2024 descending triangle, along with the important July 2021 low at 578 and the March 2021 low at 559, and back into that previously mentioned rectangle pattern area between 551 to 590. Since then, prices have moved sideways to lower, making a shallower bear channel highlighted in bright red on my daily chart, and that's currently 532 to 579. This pattern construction is the familiar V-top with an extension, as we have seen in other grain markets. As I've said elsewhere, I believe that one should not look at this extension in isolation, instead look at it as part of the derivation of the V-top. So what can we tell from such a pattern? Well, usually such patterns are small and are pennants or bear flags, but not so in this case. However, it does not take anything away from the V-top to have such a larger pattern. Thus, I said for weeks now to look for the bright red bear channel to show the immediate support and resistance levels, and it did so until late 2 weeks ago. As I've also said, for many weeks now, the pressure in any such pattern would be for lower prices, and 2 weeks ago prices punched down through and closed below the important 551 support and the bright red lower bear channel line. However, the move down was not sustained and prices reverted back up, moving up from the significant support of the important 38.2% absolute Fibonacci line at 533. The move higher went through the March 2021 low at 559, the green short medium moving average currently 572, and punched up and closed over the combination of the July 2021 low at 578, the dark blue lower trend line of the descending triangle, and of course the bright red upper bear channel line. Yet this move higher is having trouble in sustaining the move higher, running into the highs of early and mid-July and mid-August, as well as the top of that old rectangle congestion area between 551 and 590. Beyond these resistances, we have a fairly free area until the flatlining pair of the gold long moving average, currently 610, and medium moving average, currently 614, and that's mauve coloured, and the interesting 38.2% Fibonacci line of the big old 2011-2018 move. Beyond that, we have a small free area until the recent 50% Fibonacci line at 643 and the January 2015 high at 646. All this is leading me to think that this very recent move higher may not have the legs on it to get up through all these. To show you how I feel about it right now, this is despite the weekly key reversal up last week and even to target X at 627, This is the topside target I felt obliged in putting after the break up and out of the bear channel, even if I don't have much confidence in it being achieved soon. By the way, I'm prepared to retire this target as soon as next time. That is how I feel about it. There's one other feature I'd like to discuss. Again, it is the possible bow tie formation we may recently have held in early August of the green short medium moving average, currently at 572, the medium moving average currently 614, and the long moving average currently 610. This again is not a possible, but I still call it a potential, as I'm not really happy about the crossovers. However, some 15 to 20 sessions after a bow tie crossover, we usually see volatility, and sometimes in a move in the direction of the bow tie. This period was roughly between the 29th of August to the 5th of September, yesterday. And this would account for the move higher we saw, we'll call that volatility, over last week, though I still do not like what I still consider to be a potential bow tie formation. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Topic and ADM Investor Service International Limited. And here comes the final important bit.